Aloha, inspired money makers. Welcome to Inspired Money, where we explore financial strategies to help you live a richer, more fulfilling life. I'm your host, Advisor Andy, and today we're tackling a topic that impacts millions of Americans: student loan debt. Here's a stat for you to put things into perspective. The total U.S. student loan debt has reached a staggering $1.6 trillion with over 43 million borrowers. In fact, student loans represent the second largest form of consumer debt, trailing only behind mortgages. This goes way beyond big numbers. While a college degree is aspirational and can open doors to new opportunities for students, paying for it is not just a student issue. It can be multi-generational, involving parents and grandparents. If you're feeling the weight of student loans, you're not alone. This episode is for you. Whether you're a recent graduate trying to make sense of repayment options, a parent like me worried about college costs, or someone still carrying student debt after many years, today's discussion will give you the tools to take control of your financial future. Our expert panel will break down everything from consolidation and refinancing to loan forgiveness programs, and they'll share actionable tips so that you can start doing better today. Stay with us till the end because we'll not only help you navigate your current debt, but also show you how to minimize future debt and build a solid financial foundation. Before diving in, this episode is brought to you by my financial advisory firm, Runnymede Capital Management. Whether it's saving for a home, saving for college, or planning for your retirement, plotting your financial goals and documenting a financial plan can be very helpful. I invite you to do a 3-minute plan. You can go to inspiredmoney.fm/getplan. Take just 3 minutes because a little planning goes a long way. And after you finish answering some questions at inspiredmoney.fm/getplan, you'll immediately get an output, and I'm happy to review it with you to point you in the right direction. Now let's welcome in our panel of experts. I'll start with Mark Kantrowitz. He's a nationally recognized expert on student financial aid, scholarships, and college financing. He's the author of 14 plus books, including bestsellers like How to Appeal for More College Financial Aid and Filing the FAFSA. With extensive experience in policy analysis, he's been quoted in over 10,000 media articles and frequently testifies before Congress on education-related issues. Mark, off camera, you mentioned that you won a ton of math and science scholarships when you were a student. I also saw that you read the entire Higher Education Act and the Internal Revenue Code, as well as regulations in the Federal Student Aid Handbook. So we're excited to have all your knowledge and know-how here. Welcome.
Thank you.
We have Sonia Lewis. She's CEO of the Student Loan Doctor, LLC, the first African-American and woman-owned student loan repayment company in the US. She's a leading expert on student loan debt repayment. She shared her expertise on platforms like Black Enterprise, Forbes, and at the White House. She's a 3-time author. Welcome, Sonia.
Thank you, Andy. Hey, everyone.
I'm so excited to have all of you here. We have Dr. Caitlin Zaloom, who is an economic anthropologist, professor of social and cultural analysis at New York University, and author of Indebted: How Families Make College Work at Any Cost, which explores how student debt reshapes middle-class family life in America. Caitlin, welcome. And then rounding out our panel today, we have Rae Kaplan. She's a lawyer, author, entrepreneur, and radio personality who has helped thousands of Chicago families and others navigate student loan debt, bankruptcy solutions, and pre-college financial planning through her firm, Kaplan Law. Rae, welcome.
Thank you for having me.
All right. Well, we've got an incredible panel here. We're going to have a great discussion. 5 segments. Let's jump right into segment 1. Student loan debt significantly influences financial decisions and life trajectories. As of 2023, about 43.2 million U.S. borrowers carry a collective $1.6 trillion in student loans. This debt often pushes graduates toward jobs with immediate financial stability over roles they're passionate about, limiting career progression. Nearly 50% of graduates feel forced to prioritize salary due to loan obligations. Additionally, high debt can delay home ownership, as borrowers struggle to save and meet mortgage requirements. This, in turn, affects major life milestones like marriage, starting a family, and retirement planning. Many borrowers also find themselves unable to invest or save for emergencies, impacting their long-term financial security. On a broader scale, diminished disposable income reduces consumer spending, slowing economic growth. The burden of repayment deadlines contributes to stress, anxiety, and other mental health challenges. Recognizing these impacts underscores the need for strategies that balance loan repayment with other financial goals, paving the way for a more stable future. Caitlin, I want to start with you. In your book, Indebted, you got 160 middle-class families to talk about money and student debt. That's a feat in itself. Tell us some of the stories that you uncovered about the hidden consequences of student debt.
Yes, that is. It was a big achievement just to get people to talk, because of course, debt and indebtedness get to the heart of what it means to be a middle class family in the United States, and having debt is also often seen as a sort of failure, even though it absolutely is not. Is something that most middle class families face. It was really seen as a failure, and so at first people didn't want to talk to a stranger about that feeling, and I ended up working kind of outward with my students, and then with other students who I could actually get to talk about student debt, and both for themselves and with their families.
And tell us, what did you uncover from, it seemed like Kimberly, who was one of your students, and then from talking to many other students?
Yes, Kimberly was sort of my inspiration for starting the book. She came to me really in tears, realizing that the debt that she was going to carry away from college was going to shift her toward taking a job that she really didn't want. She was offered a very high paying job, one that was going to allow her to pay off the tens of thousands of dollars in loans she would take away from NYU. But that job would require her to assist with the offshoring of American jobs, and she didn't want to do that. She wanted to work in a kind of social justice and education position, but she felt like she had to do that for her own stability.
Yeah, it makes sense. I mean, you have to prioritize your path based on being in debt. Mark, where should people start seeking money? And maybe you can provide some rules of thumb, like how much money should people be borrowing?
Well, you should borrow no more for your college education than your annual starting salary. If your total debt at graduation is less than your annual income, you should be able to afford to repay your student loans in 10 years or less. So you need to live like a student while you're in college, so you don't have to live like a student after you graduate. And a key step that can help is to increase your awareness of how much you are borrowing, because that's the first step in exercising restraint. So it helps to understand just how much you really need to borrow, and don't borrow as much as you can, just as much as you need.
And it sounds like there are two sides of that. One is how much are you going to borrow, but you have to be thinking, in the future, what is your potential salary going to be based on your area of study and what job you might land?
Right? You should pick an academic major because you love it, but you should also consider how you're going to be able to repay that debt, and maybe have a minor in a field that can help you pay off your student loans and pay the rent.
And then as we think of student loans, what's the ratio? Like how much should be coming from federal loans, savings and investments, and one's current income?
Well, a rough cut is that you should plan on saving about a third of future college costs, with the next third coming from current income and financial aid, and the last third from student loans. That's a very rough cut. A lot depends on how much, on the cost of the institution, how much you've saved, and how much is reasonable and affordable to repay the student loans. Certainly, you may want to go to the most expensive college on the planet, but you probably can't afford to go there. You need to consider the net price of the college, which is the difference between total annual college costs and the gift aid, the grants and scholarships, and other money that doesn't need to be repaid. That net price is the bottom line cost of the college that you'll have to pay for using savings, income, and loans. And if you go to too expensive a college, you'll be taking on too much debt, more debt than you can reasonably afford to repay.
So, Sonia, I'm curious what you see in working with clients. Is it possible to keep the student loan debt to 1 year of your future salary?
Well, it just really depends. I think just depending on the background of the borrower in the first place. And so student loan debt just shows up disproportionately amongst borrowers. When we look at those that have to borrow student loans that are minorities, Black and brown alike, the student loan debt really may be the only option to pay for school. And I always, like to refer to something called the sticky middle. And the sticky middle is that someone coming into college may come from a household background where their household is not poor enough essentially to have a free ride, whatever the school is, community college included, but they may not be rich enough to pay out of pocket. And so what we find is the sticky middle progresses even when that person becomes an adult. We're producing more people in the sticky middle. So someone that graduates college with, let's say, 50 or 60,000 in student loan debt, it would be very nice for that person to have a job that pays that amount starting off. Is it realistic? Depending on what they study, it may not be. And now what you find is that person is behind the eight ball, if you will, trying to catch up. So a lot of the clients that we see, let's say, are mostly educators, social workers, even those that are in the medical field, again, coming into the medical field, making 100, 200,000 plus, but having 200,000 in student loan debt, it's like, how do they catch up? And that's the question. And we just need to really take a look at systemically overall.
In Caitlin's example of her student Kimberly, like what advice do you give someone like Kimberly whose student loan debt is preventing them from saving for retirement or buying a home or getting the job that they really want to pursue?
We have to have realistic conversations with our clients on this end. We are working with people that are between ages 30, and it really has changed. I've been in business for a while now, and we're seeing student loan debt into the 70s. And so you have to have a frank conversation with people to say one job may not be enough, even if it's really one good job. The idea of having another job, or people use the term side hustle, if you will, because you have to do something more to get on top of your finances, and particularly the student loan debt. And it just doesn't go away when you retire or when you start receiving Social Security. And so in this case, what I would recommend if I was to meet that person, it really is, okay, we're working 9 to 5. Well, what are we doing from 6 to 10 that can generate new money? And then also putting people in the perspective of, if they have the ability to become a homeowner, does that open opportunities for them to maybe become, if they choose to be investors? There has to be conversation about how do we find new money that's comfortable for that person to stick with in order to get on top of their student loan debt, because it won't just magically go away.
Rae, how do you help clients navigate the emotional and also the financial toll of student loan debt?
Well, I think what you said in the opening is so important, that a little bit of planning before you take out the loans really goes such a long way. because oftentimes, if you know what you're doing and you understand how, for example, the federal loan system works, you can, with some planning, you might see a difference between paying back, let's say you have to borrow $200,000 in federal student loans, or if you're a parent, we often see this with parents paying for their kids' college educations using federal Parent Plus loans. And depending on who is the borrower and where that parent is working, they may only have to pay back a fraction of the $200,000 federal Parent Plus loans that they borrowed, because they may, for example, be eligible for public service loan forgiveness. So that's essentially where if you work full-time in the public sector, and it doesn't really matter what your job is, as long as your employer is a qualifying employer, then you're only going to have to make payments on your loans for 10 years, and then the balance will be forgiven, and it's a tax-free forgiveness. So I think, for example, if you know that you are going to be working full-time in the public sector for 10 years from when let's say from when your child graduates, then you can factor in public service loan forgiveness and save tens of thousands of dollars. And it really is a huge savings. So knowing that that exists makes a big difference in terms of your planning, right? Because if you don't know that that exists, maybe you don't take out federal Parent Plus loans, but instead you take out private student loans, and then you're not eligible for public service loan forgiveness. So I think the planning before you take out loans, exploring scholarships, and knowing how the loan system works is very important, and knowing how the system works and having that kind of clarity and strategy helps bring down the anxiety levels associated with student loans and paying for college overall.
Sounds like it's worth understanding how the game is played so that you can strategize appropriately.
Yeah, absolutely.
Caitlin, I know that you've worn different hats. You've worn like anthropologist hat, but I think it was your first book. Like you were a futures trader. So I wanted to ask you, if we consider the financial burden of college tuition like an investment in our children's education, is it a good investment? Is it speculative? What do you think as a trader?
Yeah, well, right. You're right. My first book was about futures traders, and I worked as a futures trader when I was doing that research. And what I came to understand as I kind of transitioned to a new project was that everyday people were really being asked to think speculatively in a way that financial professionals are oftentimes asked to think speculatively too, and that demand to think about their investment today and its payoff later on is a very tough one, especially when it comes to young adults who may not understand what they're being asked to commit to when they take on student debt. They might be the system kind of asks them to think speculatively, and I really appreciate the idea that a little planning goes a long way. That makes complete sense. And 18-year-olds don't do that so well, and so it's a really challenging position that students are being put in at a very young age.
Yeah, so I'm hearing the need for planning, and maybe we cannot send kids to college at any cost. Anyone else want to weigh in on this segment?
Well, it's too complicated. And to give an example with the Parent Plus loans, the parents pursuing a public service job, the Parent Plus loans are not directly eligible for income-driven repayment plans. If you consolidate them, then that consolidation loan is eligible for income contingent repayment. And there's something called the double consolidation loophole, which expires next year, which would enable you to get the loans into any income-driven repayment plan. And just having to navigate all these things is not something that an 18-year-old or even their parents, and they don't have PhDs in finance, so it's really challenging for them.
Yeah, absolutely. It is. It's a very complicated area to navigate. And if you're not familiar with the system and how it's set up, it really can be very confusing. So I really recommend, especially for families who are looking at sending 1 or 2 kids to college, the earlier you can start planning and becoming familiar with the system, the better, because you don't want to be caught, once the acceptance letters are in and your kids are excited. And, parents often, they don't want to say no to their children. They want to try to make this happen for them. And we see this all the time when we want to help people, because the laws were put in place to help people, right? And there's so much relief available out there. People just really don't know how to access it. And to Mark's point, he's absolutely right. Parent Plus loans themselves are not eligible for an income contingent repayment plan, which is the monthly payment plan that's eligible for public service loan forgiveness. So this applies if you're a nurse or a doctor at a not-for-profit hospital or any public sector employment. You have to know that you've got to do the federal consolidation and then enroll in the lowest income-driven repayment plan for which you're eligible. And as he pointed out, the double loop consolidation, which is open for another year, provides a tremendous opportunity. We had a client very recently who, because of the double loop consolidation, was able to lower her monthly payment from $900 a month to $300 a month under an income-driven repayment plan. And she's going to get her loans forgiven after 10 years, essentially paying a fraction of what she borrowed and getting that entire loan balance, plus all that interest that accrues, getting that forgiven tax-free. So if this is something that your kids are thinking about pursuing, let's say they know that they want to go to medical school or something in the healthcare industry or social services, it might really be worth having that conversation. Look, are you willing to work in the public sector for 10 years? You may have a lower salary, but if we run the numbers, and that means that your parents are going to get $200,000 in loan forgiveness, maybe it's something that you look at as a family to tackle this. Not everybody's going to go to work in the public sector, right? But very often we see that people are working in the public sector and are actually not aware of it. They think that, oh, this only applies if I'm a doctor, or if I'm a nurse or a firefighter. But it actually applies if you're a professor at a university or you work, any job at that university. So as long as your employer is a public sector employer and you're 30 hours a week, you're going to qualify. So the planning aspect, I can't stress enough how important that is in terms of that directly translating in saving tens of thousands of dollars. And even if you're going to get your loans forgiven in private sector loan forgiveness, right, after 20 or 25 years, there's a good deal of planning that should go into that as well. In terms of taxes, there's some tax planning aspects that probably come into play too. So yeah, I mean, the planning, I can't stress enough.
Well, you had me at loan forgiveness of $200,000, and we're gonna.
Yeah.
I look forward to diving in more. Let's go to segment 2.
Loan consolidation and refinancing offer different approaches to managing student debt, each with its own set of advantages and drawbacks. Loan consolidation combines multiple federal loans into one, simplifying repayment with a single monthly bill. The interest rate is fixed and based on the weighted average of the original loans. While consolidation doesn't lower interest rates, it can extend repayment terms, which may lower monthly payments but could increase overall interest costs. It also allows borrowers to retain access to federal loan benefits, such as income-driven repayment and loan forgiveness. Refinancing, on the other hand, involves replacing one or more loans, federal or private, with a new loan from a private lender. Refinancing can reduce interest rates and monthly payments, but it requires good credit and a steady income. Unlike consolidation, refinancing forfeits federal protections, so it's essential to consider whether losing options like deferment, forbearance, or income-driven plans is worth the potential savings. By understanding these two options, borrowers can choose a path that aligns with their financial goals and stability.
So we heard that there are a lot of variables and moving parts. Mark, can you walk us through the decision-making process for borrowers considering consolidation versus refinancing, and when one option may be better than another?
Well, generally speaking, the longer the repayment term, the lower the monthly payment, but the more interest you will pay over the life of the loan. And if you can choose a shorter repayment term, you'll pay less total interest and you'll pay it off much sooner. I mean, if you get a 20 or 25-year repayment plan, you may still be repaying your own student loans when your children go to college. So you should choose, if you're not going for forgiveness, you should choose the repayment plan with the highest monthly payment you can afford so that you pay the least interest and you pay it off the soonest. But if you're pursuing public service loan forgiveness, where the remaining debt will be forgiven, then you want the lowest monthly payment. And so with the public service loan forgiveness, you couple it with an income-driven repayment plan, which bases your monthly payment on a percentage of your discretionary income as opposed to the amount you owe. So if you're in a low-paying field, like public school teacher, that doesn't pay very well, and therefore your ability to repay the debt is more limited, the income-driven repayment plan yields a more affordable monthly payment. And public service loan forgiveness means that the remaining debt is forgiven after 10 years under 20 payments.
Rae, how do you advise clients who are unsure whether they should consolidate or refinance their loans?
Well, that's really on a case-by-case basis. So there are some limited circumstances where it makes sense to refinance your federal loan and turn it into a private loan. For example, if you are a high income earner and you can get your federal loan refinanced for a much, much lower interest rate, and you know that you are never going to be going for a public service loan forgiveness, in certain cases, it does make sense to turn your federal loan into a private loan. But those are pretty rare instances. And, I think the one thing that borrowers need to know is that federal loans have a great many number of options in terms of payment plans, forgiveness options that may apply to you, and you never know where your life is going to take you. So it's nice to have those federal provisions under the Higher Education Act where, let's say, God forbid, you lose your job and you weren't expecting that or counting on that, and you are a high income earner. Well, now you're in a position where you can enter into an income driven repayment plan for a very, very low monthly payment that can be recalculated based on your change of circumstances, because now you have much lower income. Let's say you've lost your job or you have an illness. You may even be able to have your loans, if you're not able to resume employment, forgiven in one fell swoop. So there are only really those kinds of protections and provisions available with federal student loans. And it's nice to have those in case you need them. So it's a rare instance where I would advise somebody to take their federal loan and refinance it into a private loan, because you lose all of those options that you may need in the future, depending on what life brings you. So I would be very careful about that, because once you turn them into a private loan, there's no going back. You can't then reverse that and turn it back into a federal loan.
Sonia, what are your thoughts?
It's a very tricky topic, because I remember when we were working with clients right when the pandemic hit, and everyone that had federal loans, direct loans, were able to be put into a protective provision because of the pandemic. But you had people that had just refinanced their federal loans because they had good credit, or they were high income earners, and then they lost the protection and the provision of federal loans. And my advice in this season, especially with everything happening with the Biden administration regarding loan forgiveness, and we don't know what's going to happen due to election, it probably would not be in the best interest right now to refinance a loan because depending on the time in which someone has had that loan, depending on the other programs they could be eligible for, when we look at what the Biden administration, which would be now the Harris administration, would be proposing to do some forgiveness under, a lot of people fall under that forgiveness, but they would be opted out by refinancing. So are we advocates of refinancing here? No. Because right now it's just so much in terms of change that it would be just so sad to say, yeah, I think that'd be a great idea. And then they lose out on all of these federal benefits. And if anything we learned with the pandemic, we just don't know if there's another pandemic, or we don't know with what's happening. Just even right now, our hearts are going out to those that are in Florida with weather related things that are happening. You take yourself out of the safety and provision of what you could be eligible for when you refinance a federal loan into a private loan. Now, private on private for a better rate, that's different. But no, it's just not my first recommendation or choice to give someone, just because we've seen what has happened to those that did that, and there was no relief for them.
Mm. Kate, how do consolidation and refinancing decisions differ across socioeconomic classes? And maybe what broader lessons can we take from those trends?
Well, the major trend or the major issue that I see here is that we treat education in a very similar way to how we treat another what is usually thought of as a private good, which is buying a home, right? So when we're talking about refinancing or consolidating, that this is actually an effect of how we've designed the federal loan financing system for higher education, and that is actually a really awkward fit. It's a bit of a mismatch between the requirements of education, what we want education to do, the kinds of careers that we want people to be entering into and preparing for, like teaching, which is one of the most popular professions in the United States, and what we ask them to do in terms of their loans. So I think that there is a really a systemic design problem that we all face, and that the Biden administration is trying to take on, has been trying to take on, but there is a very long way to go.
Mark, any follow-up?
Oh, I wanted to follow up to something that was said before about Parent Plus loans, which is students at HBCUs are much more likely to have parents borrowing the Parent Plus loan than students at other colleges. And oftentimes it's not the parent who's repaying the loan, but the student. So these students are graduating not just with their own student loans, but also with the Parent Plus loans. And if they obtain public service loan forgiveness, that's only going to forgive their own student loans and not the Parent Plus loans. So the burden on students at HBCUs, which have been historically underfunded, is that much greater than students at other colleges and universities.
Is there a better alternative that they can seek?
Well, unfortunately, federal grants have not kept pace with increases in college costs. And private scholarships, there are about $7 billion of private scholarships. So, I mean, you have maybe 14 or 15% of students in bachelor degree programs receiving private scholarships with an average amount of about $2,500. I mean, well, average amount among those who receive it is just under $5,000. So this idea that you can get a completely free ride through scholarships is pretty rare. I mean, I did it when I was a kid, but I mean, most people, we're not talking about a free ride. So the things that you can do is you can save before college. I started saving before my kids were born. And you can try to pay off the student loans quicker and to keep the amount that you borrow to a minimum. You can also choose a less expensive college. Often your least expensive college is going to be an in-state public college. Even though they don't give out as much financial aid, the net price of those colleges is often a quarter to a third that of a higher cost private college. Though there are about 6 dozen mostly private colleges with these no loans financial aid policies where they replace loans with grants in the financial aid package. So shop around is a key bit of advice, and both not just for the least expensive loans or the loans that have the options you need, but also for the college that is going to be more affordable. You may want to buy a Lexus, but all I can afford is a Yaris, and that's a much less expensive option, even without financial aid.
Well, I'm hoping that we can all learn the ropes and learn how to shop around, and that it doesn't require a degree at MIT for us to decode all of this. Let's move on to segment 3.
Student loan forgiveness programs offer ways to reduce debt for eligible borrowers. Public service loan forgiveness provides forgiveness after 120 qualifying payments for those working full-time in government or nonprofit roles. Eligible payments must be made through an income-driven repayment plan. Teachers working full-time in low-income schools for 5 consecutive years may qualify for forgiveness of up to $17,500, particularly if they teach in high-need areas like math or science. IDR plans such as income-based repayment or pay-as-you-earn forgive the remaining balance after 20 to 25 years of payments based on income. Additionally, total and permanent disability discharge forgives loans for those permanently disabled, requiring verification from the SSA, VA, or a physician. To maximize forgiveness opportunities, borrowers should stay informed on policy changes, maintain detailed records, consider loan consolidation, and seek professional guidance. These steps can increase the likelihood of achieving forgiveness, reducing overall debt and financial pressure.
Sonia, what are the biggest challenges people are facing when applying for student loan forgiveness, and how do you help navigate them through the process?
We're really proud of the community and the work we've been doing. In just a few years, we've been totaling up about 50 million in loan forgiveness within our tribe. And it's exciting because it sounds like a lot of money, but it's just so much more to go in terms of forgiveness. The challenge with loan forgiveness is that people are very confused about what they're actually eligible for and what they're not eligible for. And there's a lot of misconceptions around the PSLF, Public Service Loan Forgiveness Program, or the Borrower's Defense Program, school closure, teacher loan forgiveness. It all kind of gets jumbled together. And the reality is, you really want to make sure that the person you're working with or people in general are informed. Yes, you're eligible for this. No, this is on hold. You have to have this to meet this requirement. And even though I will say, and I like to give credit to the Biden administration, they've done a great job with cleaning up studentaid.gov, just making a response a little easier in terms of when you reach out to the Department of Education. It's still a lot of information to be broken down and demystified. What we see a lot of people securing loan forgiveness through is the Public Service Loan Forgiveness Program, which has had an amazing cleanup job. The fact that they allow people to go back from October 2007 to October 2022 through the TEPSLF program and get that back credit for the work they've been doing, regardless of if they were actually in repayment, has been outstanding. And that has actually led people to seeing massive loan forgiveness. That's one of the top programs. I really appreciate how this administration also went after the schools that were just wrong in terms of how they were recruiting and the financial aid practices that they had. So it's really interesting to see who is getting forgiven, who is not yet getting forgiveness. But the key here in all of it is making sure you understand what you're eligible for and not being afraid to apply. And I know that sounds kind of crazy, but people are intimidated by the application, or I did this before, I'm not eligible. I tried years ago. And do you know how hard it is? You almost want to shake people and say, try again, because there's been some new changes to the programs.
Mark,
Yeah,
income-driven. Oh, go ahead.
No, I was just going to say, to Sonia's point, she's absolutely correct, because there's so much information out there, and people will say, well, I'm a teacher. I should probably be going for teacher loan forgiveness. Well, not necessarily. You should probably be going for public service loan forgiveness if you have, let's say, over $30,000 in federal student loans. It probably is going to make more sense for you to go for public service loan forgiveness rather than teacher loan forgiveness. But you just have to know the differences between the programs. And so you might be eligible for one, but you should really be going for the other one.
Mark, income-driven repayment can be pretty confusing. Can you decode it for us, perhaps with a little history?
Okay, so the first income-driven repayment plan was income contingent repayment, which was part of the Higher Education Reauthorization Act of 1992, and it went into effect in 1994. All of these income-driven repayment plans base your monthly payment on a percentage of discretionary income for a number of years. The definition of discretionary income is different, the percentage is different, and the number of years of repayment are different. So income contingent repayment is 20% of the amount by which your adjusted gross income exceeds 100% of the poverty line for 25 years. Income-based repayment became available in July of 2009, and that still has the 25 years until forgiveness, but instead of 20%, it's 15%, and instead of 100% of the poverty line, it's 150% of the poverty line. So it's a smaller percentage of a smaller definition of discretionary income, and therefore reduces the monthly payment. And I was actually involved in the design of that repayment plan. More recently, there has been pay-as-you-earn repayment, which was 10% of discretionary income, the same definition of discretionary income, the amount by which your income exceeds 150% of the poverty line. And it offered the option of 20 years of forgiveness, but it was restricted in who could qualify for it. Then Repay, the revised pay-as-you-earn repayment plan, became available, and that had 20 years for undergraduate borrowers, 25 years if you had any graduate loans, and it was 10% of discretionary income, same definition. More recently, there's the SAVE repayment plan, which is currently undergoing litigation, which is 5% for undergraduate debt, 10% of discretionary income for graduate debt. Discretionary income is the amount by which your income exceeds 225% of the poverty line. And for undergraduate debt, you have 20-year forgiveness. For graduate debt, you have 25 years forgiveness. And it does a weighted average, so it's not all or nothing like the Repay plan.
Kate, can you talk a little bit about your research and your definition of middle class?
Sure, but I just want to respond for a second
please do.
to the other three panelists whose expertise is really deep, and I so appreciate that. It's unfortunate as like a public policy design that that we have to turn to such experts to get a coherent description of what these policies are now and have been and what the changes are. This is very, very confusing for people who are facing taking out student loans, repaying student loans, and what we know as social scientists about effective policy is that effective policy is simple policy. This is obviously the opposite of that. So I just wanted to say I completely appreciate all of the details that we've heard, and it even makes my head hurt, and I have a very high threshold. So I'll just leave it there.
Mark, is there a hope for simplification?
Well, they did take the steps towards simplifying the FAFSA, but last year was an unmitigated disaster because in simplifying the FAFSA, there's a lot of complexity in simplifying the FAFSA, and the implementation, the rollout, had huge delays and never-ending errors. They're promising to simplify it, to do a better job this year, but they're still delaying the start of the FAFSA from October 1st to December 1st, and financial aid professionals will trust it when they see it, because there were too many rosy proclamations about how things were going well and that they would fix these problems. And we now know from a GAO report that the Department of Education knew very early on that it was going to be a disaster, and yet they still told people that things were well, even as they rearranged the deck chairs on the Titanic.
Yeah, and if I can just add on to your guys' point about that, what's going on right now in the current landscape for federal student loan borrowers, I would say, is probably the most challenging time that I've seen since I've been practicing, because of the litigation in the Eighth Circuit Court of Appeals challenging the constitutionality of this new SAVE payment plan rolled out by the Biden administration and the SAVE regulations. Essentially, what happened was people, and it was millions of people, I think 8 million borrowers were enrolled in the SAVE payment plan, which was a great payment plan. It really reduced people's monthly payments very significantly. And now it's frozen because there is a constitutional challenge to whether or not the Biden administration had authority to create this new payment plan under the regulations. And now it's just kind of everyone's in this strange limbo. Should we be in the SAVE forbearance, but that forbearance period does not count towards public service loan forgiveness? So borrowers who are going for forgiveness are in a kind of a conundrum right now. And anybody listening out there, if you're going for public service loan forgiveness, you can now apply for a different, the IBR payment plan instead of the SAVE plan, which those payments will count towards that magic 120 months that you need to get your loan balance forgiven. And they should just be prepared that that IBR is going to be much higher than that SAVE payment plan that they may have been approved for earlier. So the analysis of what should you do? Should you stay in forbearance? Should you switch into an IBR payment plan? Right now, it's a very confusing state of things when you have student loans because of this litigation and this kind of strange frozen in time period that we're witnessing right now.
You actually can't switch into the other repayment plans right now. The U.S. Department of Education took offline the online form because of this lawsuit and the preliminary injunction. And they said that you could submit a application for the other income-driven repayment plans.
Mark, it's back up. It's back up.
It's back up.
Back up, Mark.
Yeah.
So if you go online, you can actually switch over to the IBR plan. It's a suggestion. It's as of just a few days ago. We successfully helped clients, Mark. So it's up. The challenge here, here's the challenge. They said that you should expect up to a 60-day delay, but that's better than a paper application that God knows where to go. And did it get there? And did you open the mailbox? And so we'll take online over paper any day. So it is up. But I want to just say, Rae, to your point, what I'm very concerned about, it's like we put people back in time. And so before the pandemic, we had repay, right? 10% discretionary income. And now we're back at 15% or just stay in limbo. But here's the problem with that. People are so close with the changes that were made with PSLF to being forgiven. I literally have clients that are like 6 payments away. But now, Andy, they've got to go back into a 15% repayment. And we're still coming from under a pandemic. Let's not forget that, people. Like, it's just really financially very scary for people who haven't been in a payment for 4 years. And I just don't know about you all, but when something's out of your budget for 4 years and now you're putting it back in at a higher amount than when I'm like, this is unbelievable. So,
yes.
And again, I'm reading everything and I'm like, so is there no repay that'll come back? We just went back to IBR. So we hear the grunts and the tears and the concerns every day on this side of the house with people that are making, I would say over 60K. But again, not enough money that they wouldn't feel the effect of a 15% repayment. So literally I had a client say the other day to one of my team members, she said, my goodness, she was like, if I got to go into that plan, she was like, then I got to figure out what I can eliminate or what I can't pay this month, because if I can just get to month 6, people should not have to pick a student loan payment over what they can and cannot afford to pay that month. And that's where we're back at right now. And it's a really, really scary time. So I don't know about you all, but I'm just like, is something going to happen sooner than later? Because these are real American people that are having, they're not simple dilemmas, because people do care to be in repayment. People are this close to forgiveness. This does stop home buying. This does stop generational wealth.
Thank you. And I'm keen to have this panel who is so knowledgeable as things are changing day by day. Let's go to segment 4.
Understanding financial concepts like budgeting, debt management, and planning can help you manage student loans more effectively. Those with strong financial literacy skills are better prepared to avoid excessive debt and manage their loans responsibly, ultimately reducing the risk of financial distress. Programs in schools have shown that introducing financial education at a young age can lead to better financial habits in adulthood. Resources like the U.S. government's Financial Literacy and Education Commission, as well as various online tools, provide accessible information to enhance financial understanding. To manage loans wisely, creating a budget is crucial for tracking income and expenses, ensuring loan repayments are manageable. Understanding loan terms and comparing options can help borrowers choose the best repayment plans. Financial apps and tools can offer insights into spending habits, allowing individuals to set achievable goals and maintain a healthy financial outlook. Financial literacy equips borrowers to handle their loans with confidence.
Caitlin, in your research, you found most middle-class families don't want to talk about finances. And you mentioned something, you wrote about something called nested silence within families. Can you talk about that and what can be done to improve our financial literacy?
Yes, I found that, of course, like families that, especially families that are facing some financial strain, don't like to talk to people outside of the family about their struggles. I feel like that is a pretty common and thing that is very easy to identify with. It is also true that parents often did not want to talk to their children, their young adults, about their own financial struggles. And the reason that was the case was that they wanted their young adults, their growing kids, to be able to move into their education without that burden, without that knowledge that they would somehow have to carry their parents with them, going through their education and going forward into their own adult lives. And so parents made a really explicit decision not to talk to their young adults about their own financial struggles, and that was a really that was a commitment that many parents had. In fact, when I interviewed them, they would ask me not to talk to their children, who I was also interviewing, and reveal the extent of their own debt or their own kind of job situations that they face. So that was a real blockage in the kind of information exchange between generations.
Sonia, do you have favorite resources that you send clients to help educate?
Yeah, I mean, well, first thing first, if it's not on studentaid.gov, we really don't want to suggest it, because there are a lot of blogs and websites that will give you their theories and opinions, and you should do this. And like, is it on studentaid.gov? We're also really fortunate that we do a monthly Instagram live with the Biden administration. Secretary Cardona comes on and answers questions with our community, and he loves it. I mean, if you ever get a chance to catch it, guys, you should. He starts rapping at the end. I don't know. It's very hilarious. So he'll answer pressing questions for them. And then the other thing that I really appreciate in this season is that just helping people ask the lenders the questions the correct way. Because something we have to keep in mind is that the workforce of the student loan lenders was at a loss during the pandemic. So we have to be kind and keep in mind that people are coming now back to work or being hired, and they may be new. And so be nice to your student loan lenders when you're on the phone with them, because they're trying to help you navigate and figure out. But having a population of people that are educated helps them being more informed when they're calling their lender. And that's really for everyone. We want clients, and we want the American people to know how to talk on the phone to a lender, because if the answer doesn't seem right, it probably isn't. And it's okay to say, may I have a second opinion with your supervisor? You don't have to be mean, you don't have to be nasty. But what you'll find sometimes is if you call an earlier shift or you get a second opinion, sometimes that person is right versus the person who initially helped over the phone. But again, kudos to the Department of Education. There's been a lot of changes, quick changes that have been made to compensate that lack of knowledge or customer service there too. But again, just to answer your question, Andy, we stick with studentaid.gov, and it really is just the most sound thing because of the way that they're updating it in just such real time, doing a better job than they ever have with updating the website and what's happening.
Thank you. Great tips. Mark, what are the top areas of financial literacy borrowers need to master?
This is actually financial capability. And there are several good resources. You mentioned the U.S. Treasury Department has a collection of financial literacy tools. There's also NEFE, the National Endowment for Financial Education. The gist is learning how to manage your money so that your money doesn't manage you. And that can include budgeting, saving, investing, borrowing, repaying debt, saving for retirement, saving for your children's education. There's a whole bunch of subtopics, but I think the first thing that you should do with regard to budgeting is to create a descriptive budget as opposed to a prescriptive budget. With a descriptive budget, you track your spending for a month. Every time you purchase anything, you keep the receipt. You transcribe that information into a spreadsheet or into a program like Quicken that night, and you categorize that expense in broad categories like food, clothing, housing, medical care, insurance, transportation, and a few other categories. You also tag it as whether it was a mandatory expense or a discretionary expense. And a mandatory expense is something where you would die or have a very serious health issue if you didn't pay that bill. And then at the end of the month, you total up the categories. So you'll know at the end of the month that you spent $300 eating out. And as I said before, increasing your awareness of your spending patterns will help you exercise restraint. You'll just naturally spend less on eating out if you see that you spend quite a bit of money on eating out, or paid entertainment is another category that is often discretionary in nature. And then once you've done that for a while, you might start doing a prescriptive budget. And one technique that tends to work pretty well is at the beginning of the month, you put the money that you're going to spend on groceries in an envelope, the money that you're going to spend on optional activities like entertainment and eating out in another envelope. And then once you've spent all the money in that envelope, you stop spending on that category. And that's a way that a lot of people find makes it easier to budget and exercise that budget practically.
Great tips. Rae, what legal concepts are important for borrowers to understand?
Well, I think in terms of student loans, the most important thing is to understand the difference between federal loans and the benefits of federal loans versus private loans. You'd be surprised how many people we talk to every day who are not sure if they have federal loans or if their loans are private loans. And there's a big difference. Not all loans are created equal. So I think that's one of the most important things to know and understand. Also, I think it's important for people to realize that there are great resources out there in terms of both scholarships Mark's work in appealing financial aid decisions, if you're looking at paying for a college education kind of like a pie chart, and some of it is going to be comprised of your own federal student loans, some of it will be maybe federal Parent Plus loans, your scholarships and your own federal student aid work study programs. What does your school offer in terms of scholarships and financial aid packages and work study programs? Because that all lessens the amount that you may need to borrow in terms of federal student loans or private student loans. And then lastly, I usually refer clients to any bank calculator. Bankrate has a good one. Calculator Soup has a good one, where you can just pop in the terms of a loan if you're looking to get a private loan with the interest rate, and understanding the difference between a fixed interest rate or a variable interest rate and the amount of months that is your loan repayment term, because that will help you actually understand what this loan that you're borrowing is actually going to cost you in terms of monthly payments and overall what you're going to pay. There's a real lack of understanding, I find, with people in general who are not in a financial field of study or for work, and they just don't really understand what these loan terms are and what they're on the hook for. So that's one thing we want to really clear up. These are federal loans, and here are the options, and these are private loans. And if you sign this contract, here's what you're actually going to be paying back. I think knowing that and having a good grasp of that is empowering in and of itself, because then you can put in place a good strategy and you know exactly what you're going to pay, and you're not feeling like you're just constantly reacting.
Yeah, it helps to see it when you lay it out in a calculator. And what you were saying about scholarships and work study, that's the perfect segue to our last segment.
Reducing student loan debt starts with proactive planning and taking advantage of available resources. Scholarships and grants are important because they don't require repayment. Students should explore options through tools like the College Board Scholarship Search and apply for grants such as the Pell Grant. Federal work study programs also offer part-time jobs to help cover education expenses, reducing the need to borrow. By tracking income and expenses, paying interest on loans while in school, and choosing affordable living options, students can keep costs down. Additionally, starting at a community college or enrolling in dual credit courses during high school can significantly reduce tuition costs. Choosing in-state public universities can also lower expenses. For those already in repayment, making bi-weekly payments and exploring employer repayment assistance programs can speed up debt reduction. Refinancing is another option, but requires understanding the potential trade-offs, especially regarding federal loan protections. Planning ahead helps students manage costs and minimize loans.
So Caitlin had to drop off. I'm going to go to Sonia because I think you also need to drop soon. How do you advise students on balancing work study, scholarships, and other financial resources?
You know, it's something that is a conversation to be had even before going into college. I think about my own experience in college, and I had a full ride. And I was really grateful for that. But I also did not have a lot of financial support because my mom got really sick right before going to college, and so I knew that I needed to also work because I needed money in my pocket, and I couldn't ask for help from home, and so I actually find, though, and I don't know if anyone else has this experience here, that when you have students who are working and taking classes, there's a discipline there that keeps them, in my opinion, on the right track. When there's too much free time, sometimes that could be a bad thing. And the thing is, we want to make sure that we're also producing responsible citizens. So if they're in college and they're able to manage workload there, work study, able to put some money in their pocket, understanding the need for budgeting early on, they're probably more likely to be super successful when they graduate and have to be on their own. Now there could be, some exceptions to the rule. Like if you're a medical student, maybe you do not need to have a work study job. Your job, you may be doing labs and so forth. So I think it really just depends on the scenario. But to be really, really honest, I was actually grateful that I was able to balance work study and maintain my scholarship. Because when I graduated, that's the real world. I have to go to work. I may want to participate in extracurricular activities, or when you're at work and you want to be in leadership, now you've got to be at these events that require your time after work. It just felt like, college 2.0, if you will. So I think we're making responsible citizens if they're able to manage the two.
Makes sense. Mark, I get the sense that you have a very pragmatic approach to these things. What are your thoughts?
Right. So let's start with student employment, like federal work study and college work study. A little can help you improve your time management skills, but too much takes away too much time from academics. Students who work full-time jobs while in college are half as likely to graduate within 6 years as students who work 12 hours or less a week. So 12 hours is reasonable, 40 hours is not. I think you should also focus on free money first, like the scholarships and grants. For the grants, the FAFSA form is the entry point for most students. There's a supplemental form by the College Board called the CSS profile that's used by 187 mostly private colleges for awarding their own funds. You still have to use the FAFSA for federal and state aid at those colleges. You mentioned the College Board's Big Future Scholarship Search. Another one that I recommend is FastWeb. I was involved in creating FastWeb, but I left that company in 2013. But they still are one of the largest and most popular scholarship search sites. And you apply. I mean, it's part of your plan for paying for college, but it's not the entire plan. But every dollar you win in scholarships, every dollar you save is a dollar less you're going to have to borrow.
Yeah, that's a big one. And I've heard you talk about, checking at least two places, and there are those free resources. You should be weary if someone asks you to pay.
If you have to pay money to get money, it's probably a scam.
Rae, your thoughts?
Well, I completely agree with both Mark and Sonia. Those are great resources. I also like Scholarship Owl, and I think there's one College Board for searching for scholarships. Just being aware of scholarships. I find a lot of people are really not aware that there are a lot of scholarships available that they might not even be aware of. I've seen everything from if you do community service, you might be eligible for a scholarship, play a musical instrument. We have a Hellenic Foundation scholarship for, excellent students that can be up to $10,000. So as Mark said, the more you can build up in those scholarships, that's less that you have to borrow. And that's a good thing because that's free money and that's what you want. And I completely agree that there is a work academic balance where you will be able to balance a job and your academics. So you don't want to be working too much to where your studies suffer. So that's something to keep in mind too, knowing, what you as a student can actually handle. That's very important. And I would say number one is studentaid.gov in terms of understanding the federal loan system and just becoming familiar with the applications, FAFSA, and your servicer. All of these things are things that people should know and not be afraid of and be comfortable with them because they're going to be in your life for a long time, these servicers. And so you want to not be afraid of it, but embrace it. And you'll feel much better not having mystery surrounding your loans.
Well, striking that balance that all three of you spoke about, it's really important because part of the student debt problem is students who don't finish, right?
Well, I'd say that it's perhaps the biggest problem, that we don't really have a student loan problem so much as a college completion problem. the students who graduate college generally are able to repay their student loans. It's the students who drop out of college that encounter financial difficulty. They have the debt, but not the degree that can help them repay the debt. Among all undergraduate students, they're 4 times more likely to default on their student loans, and they represent about 3/4 of the defaults. Among students who are pursuing a bachelor's degree, they're actually 95% of the defaults. So if we could find a way to help people reach that finish line, we could reduce the amount of student loan defaults and therefore the financial difficulty. But even people who graduate, and student loan debt is often the same as a car payment, but for 10 years. So it does put a challenge on their budget. And it's not for just a few months, it's for a decade, sometimes longer.
Great point. Anyone want to share a closing thought? If not, then the onus will be on me. I want to thank all the inspired moneymakers for joining us for this episode, and to the panelists for sharing their insights. It's been a really informative discussion. I learned a lot about student loans, from how they shape our financial futures to strategies for managing, paying off, and even having loans forgiven. One big takeaway for me from this conversation is the power of being informed. This is not a simple concept to wrap your head around. It's very dynamic. And as you can see from the discussion today, it takes a lot of time and effort to be up to date on the important issues, and what kind of programs you can qualify for, both on the loan side, scholarship side, and loan forgiveness. So to navigate the student loan landscape successfully and make choices that align with your long-term financial goals, it takes a little work. So my call to action for you this week: take an hour to review your student loan situation. Whether you're already have loans or you're planning to take on loans, look into the status of your loans, explore your repayment or forgiveness options, or research scholarships and grants if you're still in school. Check out the books and resources from today's panelists, and take an hour this week. Taking an hour can really make a significant step toward managing and reducing your debt burden. Thanks once again to Mark Kantrowitz, Dr. Sonia Lewis, Dr. Caitlin Zaloom, and Rae Kaplan. Thank you everybody for tuning in. I encourage you to follow our panelists. You can find Mark at kantrowitz.com. Mark, you have a lot of websites that you've been affiliated with. Do you have any other websites you want to share?
Well, I mentioned FastWeb. I helped create that website, and FinAid.org. FinAid and FastWeb merged in late 1990s. And I have privatestudentloans.guru. It's a free site, not supported by advertising, that provides some tips about borrowing private student loans, when you should, when you shouldn't. And I've written many books: How to Appeal for More College Financial Aid, Who Graduates from College, Who Doesn't. The Filing the FAFSA book is a bit old, really needs to be updated, especially with FAFSA simplification. But there are a lot of books that people may find helpful. Twisdoms About Paying for College has over 400 tweetable wisdoms, rules of thumb, that are still mostly valid.
That's great. Dr. Sonia Lewis, her company is the Student Loan Doctor LLC. You can find her at drpleasehelpme.com. And Sonia also has 3 books. Sonia, anywhere else you want to send people?
Well, we have our most fun and most engaging on Instagram, because that's where we do a lot of our IG lives. And you'll see pretty soon we'll have Secretary Cardona back on there. And we also do a lot of free classes. And so this Sunday we have a free class just explaining what's going on in the world of student loans. And we have over 1,200 registrations for that. And it's a very, very nice community. No one is making anyone feel bad about owing hundreds of thousands in student loan debt. The key is just finding the solution. And so check us out. We have we make student loan debt. I don't know if you can make it fun, if you will, or tangible to understand. But it's a community and we celebrate each other as people have wins. So I tell people, check it out.
That's great. The IG Live sounds fun. I want to come
It
on
is
and
really fun.
I want to see the rapping and learn something about
Now
student
that
loans.
caught me off surprise. I did not know but he raps every time. I can't make this up.
That's fantastic. Rae Kaplan, Kaplan Law Firm. You can find her at raekaplan.com, financialrelief.com. Anywhere else, Rae?
No, that's pretty much it. We try to go on TV whenever we can, usually on WGN, Fox 32, to talk about new developments and things that are going on in the student loan world. And of course, Instagram and Facebook and all that kind of stuff too. But there's a lot going on, so stay tuned because we'll have a lot of updates coming, hopefully within the next couple of months.
Thank you. And Dr. Caitlin Zaloom can be found at nyu.edu. You can read her book, Indebted, How Families Make College Work at Any Cost. And thanks again for joining. The next Inspired Money episode will be Building Generational Wealth, Strategies for Long-Term Financial Success. That's next Wednesday, October 16th at 1 p.m. One of the panelists will be Rabbi Daniel Lapin, who's a renowned author and speaker who blends ancient Jewish wisdom with modern financial principles. It's going to be a great panel. Until next time, do something that scares you because that's where the magic happens. Thanks for joining.